Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're covering financial results again, and we're talking about one of the largest regional insurers as well as its parent company. We're speaking, of course, about Guardian Holdings Limited for its fiscal 6 months ended June 2023, as well as NCB Financial Group, which would have posted results for its 9 fiscal months of 2023. Let's take a look at how both of those groups would have performed and what investors might expect in the coming months ahead. Turning firstly to GHL or Guardian. Well, for that 6-month period ended June 2023, as mentioned, the group posted an earnings per share figure of $1.08, which was a 96% odd improvement from the 55 cents recorded in the prior comparable period. Now, take this again with a pinch of salt. There has been some earnings restatements, and that is going to filter through the GHL's results, as well as eventually NCBFG's results over the course of fiscal 2023 and beyond. Now, driving this performance was an improvement in net insurance and investment results, up 43% from $540.6 million to just under $773 million. Now, the majority of this improvement would have come from that investment result operating segment, and driven primarily by a very significant turnaround in fair value gains from unrealized fair value gains from investment activities, which would have been a fairly significant loss in the prior comparable period. So certainly benefiting GHL's reported performance. Net income from all activities up 58.9% from $617 odd million to just about $857. Ultimately, profit attributable to equity holders up around 95%. From $128 million to just about $251 million. Now, when we take a look at operating profit by segment, certainly it makes for good reading on paper, with the life, health, and pension segment in that orange up just around 96% from $310 odd million compared to the prior $157 odd million. Property and casualty, that particular segment, up 86% odd to $150 million from $80.6 million. The insurance brokerage segment, smaller but generating a pronounced improvement of 112% with 35.1 million contribution to operating profit, and asset management up just around 5.5% from 21 million to 21 million from 19.9 million in the prior comparable period. Now, from a value perspective, the price to earnings ratio may not make as much of a good comparative, given that those earnings are continuously being restated as we move through subsequent periods. But we're taking a look at the book value per share of Guardian Holdings Limited, and we see that there was some recovery with the book value per share moving from just about $18 in the prior comparable period to just around $19.90, 19.87 to be specific. And with price adjustments, that improvement in book value has brought that price to book ratio down from 1.5 times in that prior comparable period to just about 1 time. I think it's about 0.95 times to be specific, which means that investors are, on a relative value basis, paying less for the book value per share of Guardian as opposed to prior comparable periods. So certainly one to watch at a price of $19.01. Guardian is trading at that price earnings ratio of 3.6 times. Again, take that with a pinch of salt, given that those earnings in prior periods are going to be restated as we move forward. This is compared to the sector average of 10.8 times, and Guardian offers investors a dividend yield of 3.9% compared to the sector average of 7%, which may be a little bit skewed given the fairly robust dividends of NEL in recent periods. So with higher insurance revenues in mind, but also with one eye on those increased finance expenses, the continued adoption or impact of the adoption of IFRS 17, and of course that inherent volatility built in because of those unrealized mark-to-market gains, on unrealized fair value gains rather, Bourse is maintaining a market weight rating on GHL for the time being. Turning very quickly to NCBFG, where the group would have reported an earnings per share figure of 18 cents per share compared to roughly 36 cents per share rounded in the prior comparable period, of 48% decline. Net results from banking and investment activities up just about 5.9% from 3.5 billion TT equivalent to 3.718. Overall net operating income actually declined 8.3% from 4.6 billion to 4.24 billion, and that was driven by weaker than expected or weaker than forecast results in its insurance activities segment. I'll come to that very shortly. Overall net profits attributable to equity holders declined at 47% from 1.13 billion to just about 600 million. When we take a look at that net operating income by segment, we can see a relatively good performance in most segments. Net interest income, for example, increasing 6.8% period over comparable period to 2.272 billion TT equivalent. We can see net fee and commission income also up just around 11% from 840 million to 932 million. And gain on FX and investment activities up just around 54% from 308 million to 476 million in that red segment. The major negative driver for over the comparable periods would have been net results from insurance activities, falling 53% from 1.116 billion to 522 million. That would have been attributable to somewhat of a lag factor in consolidating the results of GHL into NCBFG's earnings results, and that might be expected to improve in subsequent reporting periods. Now, from a price earnings ratio perspective, again, NCBFG is looking on the cheap side of things, trading at a trailing 12-month price earnings ratio of 8.7 times with a trailing 12-month EPS of 34 cents, which is a little bit lower than that 44 cents in the prior comparable period. But all in all, investors are facing relatively cheaper valuations for NCBFG from a price earnings perspective, as well as a book value per share perspective, with that price to book ratio as also declining to below 1 time, with the book value per share of NCB and TT dollar equivalent currently at $3.21. So at that last price of $3, NCB, as mentioned, is trading at a price earnings ratio of 8.7 times, which is well below the banking sector average of 12.5 times. It offers no dividend, having not paid a dividend over the past 12 months. There's a 0% dividend yield compared to the banking sector average of 3.2%, which could explain to some degree why investors have been a little bit apprehensive about NCBFG as a particular investment to include in their portfolio, given that banking sector stocks have traditionally been viewed as stable dividend stocks. But with resilient banking revenue in mind, keeping one eye on that weaker insurance revenue, which is expected to improve in subsequent quarters, those relatively attractive valuations, notwithstanding that dividend absence, Bourse is maintaining a market weight rating on NCBFG for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. Stay safe, happy investing, and we'll see you next time on the Bourse Report.